the headlines from the world of macroeconomics and showing you how the news applies to real estate investing. My goal is to help you stay informed, make better decisions, and of course, to make more money. Let's go ahead and dive right in. This week, I've been hearing in the news quite often all of this kind of whispering about the Trump administration going into the currency market and purposely pushing the dollar down by manipulating the entire market and decreasing the value of the dollar. I pointed out this, or I saw specifically this Wall Street Journal post that's talking about it. And here it's saying that Trump rejected the proposal to weaken the dollar through market intervention. That is what happened as of about a week ago. But I've been hearing more and more of this throughout the financial media, especially in the last week or two. And, what was it, maybe a week and a half ago, Trump put the extra 10% tariffs on the Chinese. And then they came back with allowing the yuan to go down under 7 yuan per dollar. And just as a reminder, that is not necessarily a manipulation because they were artificially propping the yuan up, making it more expensive. So when you hear in the media or you hear Trump, the administration, post that China's a currency manipulator because they're manipulating their currency down, it was actually quite the opposite. They were manipulating their currency up, and all they did is stop manipulating it, ironically. And that's when they let it float a little bit more, it came under some pressure and went down under the 7 mark that's so important. So how does this apply to real estate investing? Well, let's start with the stock market. And the news of these tariffs and this, if you want to call it a currency war or the beginnings of a currency war, this really tanked the market on Monday. And since then, we've had a lot of volatility. That was per Trump's tweets. And then I think on Monday specifically, that's when the Chinese came out and announced, or they allowed the yuan to go under 7. But since then, we've had a lot of volatility in the market. The markets don't like a trade war, and they like a currency war even less. So taking this back to real estate, if I'm a foreign investor and I'm thinking about putting capital to work in the United States buying real estate, let's look at San Francisco or LA or New York as an example. We all know there's a lot of foreign buyers in those markets, and that's one of the reasons why prices have gone up there, at least in the last 5 years. The main reason these people were bringing their money from country XYZ to the United States is because of a stable currency, because they thought that they could park money here, it would be safe, and they would maintain their purchasing power with that asset that was denominated in US dollars. Well, if the government comes out publicly, and again, they have not done this, but if they do in the future, if they come out publicly and say that, okay, we are now intervening in the currency markets, it is our intention to actually weaken the dollar because we can't let the boogeyman, whether it's the Chinese or whatever country we're afraid of now, we can't let the boogeyman beat us and play unfair. So we're going to, if they're going to bring the currency down, well, we're just going to bring our currency down further. That's the definition of a currency war. And if the United States gets into that game, well, all of a sudden, if I'm a foreign investor and I have assets denominated in dollars, I don't like that at all. I want to get rid of those assets. I want to get rid of those dollars. I want to take that wealth, that purchasing power, and I want to move it into a jurisdiction where the currency, where I feel as though the currency is safer, and I'm going to maintain, or there's a better possibility of me maintaining my purchasing power. Obviously, there's an argument that the United States dollar is the cleanest shirt in the dirty hamper, and I totally acknowledge that. But my main point in bringing this topic up is to just really point out the fact that, hey, this could happen in the near future. And if it does, it's going to put pressure on these markets on the coasts, especially in the high range, the high dollar range with the high value properties that a lot of these foreign investors were purchasing. But now that's not to say that these markets are going to implode. It's just to say that there is going to be an additional headwind there. And remember, on this channel, And on these videos in particular, my main goal is to get you to start thinking about macro, but it's also to get you to realize that it's not about possibilities. It's about probabilities. And is it possible that XYZ could happen? Absolutely. What we have to do is, as astute investors, is we have to assign probabilities to each one of those events playing out. And then we have to make decisions on what is most probable to occur. You'll notice what most real estate investors do is they just look at what's possible. Well, as an example, I think that interest rates in the United States are going to stay low forever. I think we're going to be the next Japan. Okay, that's stating what is possible. That's not stating I think that there's a 45% chance that the United States becomes Japan. And I think that because bam, bam, bam. Because fact number one, fact number two, fact number three, fact number four. You see the big difference there? And if I could do one thing with this entire YouTube channel, it would be to encourage you to really start thinking along the lines of probabilities and not possibilities. So then moving on to these more linear markets, as far as having kind of a trickle-down effect, if the dollar goes down, now we're going to start seeing a lot more inflationary pressure. If the dollar on the DXY goes from about 98, where it is right now, down to, let's say, 70, where it was in 2014, not that long ago, that is going to put massive inflationary pressure on the entire country. Anyone living in the United States paying their expenses in dollars or paying for things, goods and services in dollars, the chances is that their purchasing power is going to decrease and the cost of goods and services is going to go up. And again, remember I said the chances of that, not that we're going to see inflation if the Trump administration intervenes in the currency market. A big difference there. We're just going to see inflationary pressures, not that those pressures won't be overwhelmed with deflationary pressures, but it's just to acknowledge that they're going to be there. So what that means is your renters in the Midwest, they might have or start to have a problem paying their rents, because what are you going to do if your wages aren't increasing with the cost or with the rate of inflation? What if wages aren't going up as high as rents, and rents are already at astronomical levels? You say, well, in that case, they'll just, you'll have more buyers. Well, no, that's the way it's traditionally been, because there's traditionally been this inverse relationship between rents and prices. That if prices get too high, it makes it cheaper to rent. And if it's cheaper to rent, then people transition from buyer to renter. And then if rents get too high, well, now all of a sudden it becomes cheaper to buy, and then you go from renters to buyers. So this, along with household formation, are two of the main drivers in both rents and prices. Well, right now you've got rents and prices high. So how does that work? If prices go higher, if rents go higher and prices are already high, there might not be that historical inverse relationship that we've seen. It's something to really, really monitor. So just to recap here, because I know we've kind of gotten into the weeds. First and foremost, we need to pay attention to what's going on with the Trump administration and potentially getting into the currency market to manipulate the dollar down. That's number one. Number two, if that happens, and it's a big if, then we need to look at these coastal markets where there's been a lot of foreign direct investment and say, okay, there's going to be some additional headwind here. Number three, we need to look at then, if that plays out, then we look at the Midwest, then we look at the inflation rate potentially going up. We really monitor the CPI, which is the Consumer Price Index. And if that starts to go up, there could possibly be rents going up. Then we look at the wages to see if they're going up. If they're not going up, then there could be some pressure on rents. And you say, well, where do people go? They have to live somewhere. What they do is they get smaller. So you're going to have more people living in smaller spaces, just like they do in Europe. I'm not predicting that that's going to happen. I'm saying pay attention, and there could be some pressure there one way or the other. So that is today's video. I had another topic that I was going to address, but I want to try to keep these a little bit shorter. We'll save that topic for Monday. I hope you guys have a fantastic weekend. Make sure that you hit that subscribe button. Make sure you hit the notification bell. Give me a thumbs up if you like this type of content. We'll keep doing these videos, the news videos, on Monday, Wednesdays, and Fridays. And as always, if you have any questions, make sure you leave them in the comments below, and I promise you, answer those questions as soon as I can. You guys have a great weekend, and we'll see you on the next video.